All right, so welcome to another video. Today we're going to take a look at Caterpillar or CAT. We're going to take a look at a shorting strategy or doing something with a vertical. So let's take a look at that. Keep in mind none of these are recommendations to buy, sell, or trade, just my own personal opinion. If you want to grab my opinion, you can do so on our website at risetolearn.com or check out the Traders Fly website. That's where we also have a lot of live classes that we have coming up. One is on market season, so this one's coming up fairly soon. And that is next month, so you can register for it here right now, actually. So go ahead, check that out, and get started. Okay, so let's kick things off with Caterpillar. I want to show you just kind of my thought process on how you might go about shorting something like this, and why you might even do a short. So the whole point behind, if we just look at the overall market, we've been grinding up to the upside the last week or so, and stocks are a little top heavy. And what I want to look at is when you look at things like Caterpillar, these things have been moving quite a lot even beforehand, even before that market started to make its move up. So it's been moving quite a bit. Now, if you just go ahead and do a measured move of just how far has this moved? In the last 21 days, we have moved about 45 points. So again, 21 days, about 45 points. So if you look at the expected move and we go to Caterpillar here and we type in cat, okay, and here we got 23 days. So 23 days, the expected move is only 13 points. Okay, so think about it. 23 days, the expected move is about 13, again, on one standard deviation. So it's about 13 points. Okay, so here what we've done is we went ahead and went from here to here in 21 days, about 3 times that, 45 points. So quite a bit. And what I want to do is set up a short position. Now, you could do this on any stock that's extended quite a bit. Even stuff like Nike, you know, they talk a lot about a Nike, but this hasn't run as much. So this is why I'm choosing Caterpillar in this case. This could apply into a lot of other stocks that you might go ahead and look to shorting. And in a market that's already very high on the short term high, medium term, long term, it's still actually a pretty decent value, but short term, this thing could pull back actually. So if we want to short something, I would do something like maybe a Caterpillar, or maybe because, hey, you don't like Caterpillar, I don't know. So what you could do is, first thing you want to do is check the earnings date, and the earnings date here that we have on Caterpillar, we'll just type it in. And here we've got an earnings of approximately 428. Now, double check that. This is just kind of my screen, but you always want to be double checking that because not every earnings calendar is perfect. So let's go in Caterpillar, and I want to make sure I do it beforehand. That's going to be about the 38 days. That's like one day before. I'm going to go 31 days. So to set up this trade, I'm going to go right at the money, and I'm going to go ahead and buy a vertical put strategy. And the reason for this is this defines the risk very simply for, hey, I risk one to make one, right? Because if you're going in and selling, let's say, call verticals on it, you'll be further out. You know, you could sell call verticals at the 240. You could sell call verticals at the 250. You could even sell calls just overall. But the problem with that a little bit is that if it runs against you, you have to risk a lot more. So let me just show you the difference here. So let's go in and let's say we sell the 240 vertical. Okay. So now if I sell this 240 vertical, I can make $57. Okay. So that is kind of the amount that I can make right there, $57 at expiration. However, my risk here in the trade, let's just pinpoint some of these things out right here, is my risk, if I look at it, is $443, whereas I'm trying to make 57 on a risk of 443. So when you look at the ratio of that, you know, you're risking, what is that, almost 9 to 1 to be able to profit there. But yeah, the chances and probabilities are, of course, in your favor. However, if we want to risk actually a little bit less, this one, I'm risking 253, and I could actually let it go to a full expiration. So I'm risking maybe 253, okay, to be able to make 247, risking one to make one. So it's a 1-to-1 almost setup, risk to reward strategy. Now, Remember, stocks wiggle, and I don't really need it to expire there because the probability of expiration is actually a little bit not as great as just kind of for it moving down. So even if this thing just moves down, let's say 5 or 10 points, going to about 120, 140, 150 even, I could go ahead and take that trade off. So this is how I would set up this trade, and I would simply just let it expire if it goes against me because you're buying the puts. So if they expire, they expire. If it doesn't work, it doesn't work. But let's just show you how this process would work. So I would go in and get one contract filled. I'm going to go in. This is right at the money. It's a 50-50 spread, so half on, half off, 50% chance kind of. You don't know if it's going to go up or go down, but you're looking, hey, the stock's extended, so chances are it's probably going to go in and expire, go in your direction. That's why you're putting a trade on, because it already ran up quite a bit. So in the next 31 days, can it just pull back a little bit? And that's what you're really looking to do here. So we'll go ahead and we'll play with the order. And this is what you do, is you just kind of work the order and you let it sit. Normally you let it sit for a little while. And I'm going to rush this order a little bit more just for video purposes. And we'll go ahead, boom, there we are. Now we are short this position and we are down, about $7.50. So how do I go ahead and put this order in now to close and cancel this thing out? Well, what I'm going to do is say, okay, well, here we go. I'll analyze the closing trade. To do that, you just go in and you say, okay, well, I'm going to go ahead and right click this, analyze closing trade, sell a vertical. And now what I can do is say, hey, well, what am I trying to make? Well, I'm probably trying to make here, if I can, the most I can make is 240. Maybe I can make about a buck, $1.20, about half of that. So to be able to do that, okay, let's change our sell price about $3 and let's try 75. So that'll give me about $115. So that sounds pretty good. So all I need to do is go right click, create a duplicate order, and this will put the order through here, and I'm going to set it for a good till cancel. So once I put this in right here, I'll put it back in my 50-50 trade, and the order now is good to go. So if I look at my orders in Caterpillar right there, I can see right there, I've got this order, and I've got the order right there that's sitting there waiting and kind of working already on its own. So, and I can cancel it from there if need be, but there, now I've set up that trade. And if it goes in and hits it, goes down, touches, I'm out. If it doesn't go down there, if it's, just kind of expires, then I could just let it expire completely worthless as well. So that's how you could set these trades up. They're really nice from a risk perspective. The risk is just fully defined. It's just completely defined. So if it expires, hey, you're risking that much. But if it just pull back, all you needed to do is just go ahead and touch it, and you take it off, about 30 to 70% in profit, depending how it's moving. If you had 5 or 6 contracts, you could take off 1 or 2 as it keeps moving, then take off another 1 or 2 and another 1, 2, and it can keep working in that way. So these are nice, simple little trades to do from the short side, especially in these kinds of market conditions where right now where you are popping quite a bit, stocks may be a little bit extended. And it's like, hey, I want to put on a few short positions, maybe for a downside move in the next 30 days, because the market still could be a little bit, have some cold feet here in the future. So you're kind of getting these things going. Now, if you want to check out some more of these different types of strategies that we'll talk about in different market conditions, just check out this market seasons class. You can do that on our Traders Fly site, and you can go ahead and register right there. We're going to cover quite a lot from normal uptrending markets, what to do in those kinds of markets, different strategies, sideways markets, top heavy markets, markets at the top, because there's just different seasons in the markets, nasty sell-off panic markets, and that kind of thing. So I'll show you different setups, and you can ask me questions simply as, when you go in and you're in the summer months, you'll probably be wearing more of your swimsuit, but in the wintertime, you'll probably be wearing more of a jacket, and that's what this class is all about. So anyway, I hope you enjoyed this video overall and strategy, concept, and idea. Feel free to subscribe to the YouTube channel if you're brand new. Check out the Discord channel as well if you want to communicate, ask questions, or get announcements, and get on the newsletter list from the email list right there on the Traders Fly site. There's a lot of freebies out there, so that way you get notified as we release these upcoming classes. Anyways, thanks again. Enjoy the rest of the week ahead, and I will see you next time.